Hello and welcome to the CNBC-TV18 News Newsroom. I'm Sonal Bhutra. With me, as always, is Pavitra Parekh. You're watching MF Corner. Well, you know, Pavitra, we keep discussing a lot of these fundamentals, the basics of mutual fund investing, but we do keep getting in a lot of queries as well. Yeah. So after a long time, I thought let's collate all of them together. People have written to us on Twitter, they've emailed us, they've actually replied to our stories as well on Instagram. So let's get going and address most of them because we have an expert joining us today.
Oh, absolutely. There have been a whole lot that have come in. So let's get straight to it. We have Prableen Bajpai joining us. She's from Finfix Research and she's going to help us, go through all of these individual queries that have come in. Prableen, always a pleasure having you on the show. So thank you for taking the time today. The first query, let's just get down to it, comes in from Shubham, who's writing in from Mumbai. And he's asking whether he should continue to invest in active funds. He's saying more than, half of the funds which do invest actively are really unable to beat the index. So what should he do in this kind of context? Prableen, this is a query that, we've got several times as well. If you look at it over maybe a 3-year kind of period, there have been a decent number of funds that have not managed to beat the index. What would you suggest?
Hi, Sonal, and hi, Pavitra. Great pleasure to be here. I think, Pavitra, this is a question that even we get a lot, that whether they should, investors should move into passive investing. And I'll give a bit of a background here. If you look at the SPIVA report, which captures how active funds have performed as compared to their benchmark indices, we are looking at 80 to 90% underperformance in the large cap space on a 3-year and 5-year basis, and we're looking at about a 61% underperformance on a 10-year basis. This is in the large caps, and we are seeing similar trends in the mid cap. Of course, it's not that accentuated, about 50% underperformance there. And this has primarily because of the fact that, SEBI, after the recategorization of 2018, the investment universe now for the schemes is very tightly packed. So you have, 100 stocks in for the large caps and 150 for the mid cap. And of course, we have the small caps, which is a much, much larger segment. So I think given the context and, how the situation and structure of funds is in India, I feel that a combination approach of actives and passives can work best. There are merits to both strategies. There is a place for both in the market and investor portfolios. And while passives can actually, take away the disadvantage of probably underperforming the market and, not being in the best performing fund, it can give you that comfort that you have your core portfolio created with funds which are going to give you the market returns. At the same time, Pavitra, what happens is with passive investing, because the bigger companies get a higher weightage and whichever stocks are moving up, they start to get a higher allocation. Somewhere value investing gets left out. So I think that is the space for which, active funds definitely can add some value, as well as during downturns, because passive strategies cannot hold too much of cash. So 95% has to be invested at all times. 5% cash can be held. So I think for these two reasons, and also for some market segments like small caps where the investment universe is large, I feel that there is scope for active. So overall, I think a combination approach is best rather than choosing one of the two approaches of investing.
Okay, that is diversification as well, right? And different types of schemes is where you can put in your money to get benefits of all of them. The next one is an interesting query, Prableen, and it is for investing for a kid. So Shehzad is writing to us from Pune. He says his little one is 4-year-old and he wants to start a monthly SIP in his kid's name. His kid has an Aadhaar but doesn't have a PAN card. He asks which schemes he should look at. His time duration is long term, which is around 10 years minimum. He also asks if the investment requires a PAN card, and he's going to do his SIP in his kid's name. So first, should he do it in his kid's name? If yes, for this particular goal that he has in his mind, what kind of schemes would be possible?
Absolutely, Sonal. I think it's a great thing to start with the investments in your child's name, because it will always have, I think, more discipline, because you will not redeem, I think, something that is there in your child's name, especially when money is needed. So that brings in the discipline, the commitment towards those investments. And yes, investments can be done in his son's name, even if he doesn't have a PAN. So all they require is an Aadhaar and a bank account, which is a minor account, and it has to be under the guardianship of the father or the mother. So if these two requirements are fulfilled, and the parent under whom the guardianship, the bank account is there, that parent should have a KYC. So if these requirements are met, the investments can be started in the child's name. There is no issue. The PAN card will be needed when the child turns 18 and the investments are properly in his or her name. And I think with education inflation in India at about 10 to 12%, the sooner he starts, the better. And the longer time period he gets, I think the compounding can come into play. So for an investment of about 10,000, Sonal, at 12% returns, if we see he can create about 24 lakhs in 10 years. And if the investment is kept for 15 years, the same returns, the same investment can actually give him 50 lakhs. So the remaining 25 lakhs is actually added in those remaining 5 years. So, the earlier they start, the better. And it's totally possible with these three requirements.
Okay, that's very helpful. And, maybe we should also highlight that when the kid does turn 18, you do have to make that switch on all of the documents and change it, because otherwise the SIPs will stop. It's not something that you can continue after the child has turned 18 years of age. The next query comes in from Tarpan Satish, who writes in from Mumbai. Now, he's asking which mutual fund schemes he should look at from a 30-year perspective. I already like this query, Prableen, but you tell us from a 30-year perspective. I mean, I'm sure we're looking at equities, but what within that?
We've already had schemes, Pavitra. We have certain schemes which are, close to 28 to 30 years of existence in India, and we are looking at almost double-digit. I mean, barring one or two schemes, almost all of them have given double-digit returns. And going forward, if we go with what Prime Minister Modi has, set a target of being a developed economy by the 100th year of our independence, I think what we are looking at is a 25-26 trillion economy. And that is what EY report has also actually projected, with a per capita income of India at about $15,000. So that's going to be huge. And if we do see India becoming a developed economy, I think the markets would follow. And again, with the 30-year, I think, horizon, I would go with a passive strategy primarily. So 70% passives, large and mid caps. And I think the rest 30% can be in active. It can be in the form of a small cap fund or a large mid cap fund to fill in the gaps which are there in passive investing. So I think an overall 4-fund portfolio with a mix of passive investing and 70-30 proportion.
Okay, interesting answer there. So let's get to the next one, because Amit Jha is writing to us from Bhopal. He wants to know if he should continue investing in Axis Bluechip Fund SIP or exit. Prableen, this is one fund which we have gotten a lot of queries for as well, which has been underperforming despite it having a long-term, diversification, or would say portfolio as well. What do you suggest? Should investors be patient with this one, or they should completely exit here?
So I'll totally agree. Axis funds, almost all of them have been under the radar, and a lot of queries regarding whether the investors should continue or exit. So I'll give a bit of a background here. If you look at the period of 2017 to 2020, Axis performed wonderfully well. 2018, and I'll draw a comparison with another fund here, which is HDFC Top 100. 2018, Axis was giving 6.5% returns when HDFC was giving 0.13% returns. 2019, Axis delivered about 18-19% returns, and HDFC was only giving about 7% returns. 2020, again, close to 20% returns for Axis and just about 10% for HDFC. And today, 2023, Axis is given about 7% returns, and HDFC is up by about 17%. So I think the first fact which needs to be established is that there are good and bad phases for all funds. And Axis had a very focused strategy in terms of, just following the growth strategy of investing, which took a hit when interest rates started to rise. And they had huge allocations to stocks like Avenue Supermarts and, IT sector, Bajaj Finance, which haven't really performed. So I feel my answer would be, if you're looking to continue in a large cap fund, within large caps, you want to continue in an active fund, then maybe you can be patient and give the scheme some time, because we've seen huge, churn in the management. We've seen some new people coming in top management. So probably you can be patient. But if you're looking at a really long-term portfolio, 10 years and beyond, then I think maybe in the large cap space, you can actually exit and start with a passive fund, an equal weighted Nifty strategy. And I think that should be good because, looking at the underperformance amongst a lot of schemes, and there'll always be periods when some scheme or the other is underperforming. But if you want to continue with an active fund, then probably some patience can be kept for a while.
All right, maybe give it a little bit more time since, like you mentioned, there's been so much of a change in the management as well. Prableen, very helpful advice, but we do need to take a short break. We're going to be back in just 2 minutes. Lots more queries coming in. Stay tuned. We'll answer all of that in just a bit. Hey guys, welcome back. You're still tuned into MF Corner, and today we're answering all of the queries that you have sent in to us. We have Prableen Bajpai with us to help us with that. So let's get to the next one. We have Nishant, who's written into us from New Delhi, and he wants to know whether it is safe for new age investors to use platforms like Paytm Money to start with MF investments for a long-term period. He's asking how will this impact investors if these platforms dissolve and one has to redeem their investments later on. Prableen, there are a few investors who have these kinds of, concerns with some of the newer platforms. What would you suggest? I mean, it's a very tightly regulated industry, but what would you suggest to someone who's, using a Paytm Money or a Grow or something of that sort?
Pavitra, it's hard to say, how these companies would be, if they will be in existence 10, 15, 20 years from now or not. But for all the platforms, be it these fintech platforms of your banks or any distributor, the investments are finally held by the AMC, and investors will always have the rights. If they have their statement of accounts and all documents in place, they can directly visit the website, go to the AMC office, and redeem and make changes if they want to. Also, Paytm Money is registered as a SEBI investment advisor, and as a RIA, investors, as their portfolio increases, and at some point, if he or she feels that they want to change their advisor, they can always do that. There is a form, scheme wise, you can change your RIA or your distributor, so that option also exists for investors. But yes, I feel till the time the amount is not too large, these platforms are fine. But I think as the amount becomes larger, probably somebody with a face-to-face interaction or a different sort of a mechanism is what investors look for, because probably that would involve their financial planning and other aspects of their financial journey as well.
Prableen, after Access Bluechip Fund, before that, it was one of the queries that we got across all the platforms, whether they should go ahead with these new platforms to invest into mutual funds or not, or if they should go ahead with the existing investment advisors or not. So that's very helpful. Moving on to the next one, Neeraj and Navind Gigar writes to us from Hyderabad. He's a beginner in mutual fund investment and wants to know whether his goal should be to create a corpus or should he aim for capital appreciation through higher returns. Very interesting one there, Prableen. What's your take?
So it's cause and effect, actually. Even to create a corpus, he would have to have returns coming in, and there will be capital appreciation which is involved. But I think Sonal, as somebody who's starting off, I think it's so important to list down your financial goals and give it a number. So let's say somebody wants to make a down payment for a house 7 years from now, and today the down payment requirement is about 25 lakhs. With that figure in mind, he or she then has to estimate, factor in inflation and decide, okay, after 7 years at 6% inflation, probably something around 38 lakhs would be required for the same down payment, and then start investing. So I think the best way is to list down your financial goals, give it a number, factor in inflation, and start investing. And other than mutual funds, especially equity, there are no other easy mechanisms which would help investors to create, inflation adjusted, positive returns. So I think higher returns is something that will happen only over time. So anyway, whatever goal he keeps, the idea is that with equity investing, he will have to keep the patience, and there are there will be lows as well as highs in this journey. So he has to stay put during the lows.
Okay, got that. The next query comes in from Ravi Kumar. He's writing in from Patna. He says he has invested in the Canara Robeco Emerging Equities Fund all the way since 2016. He's put in 20,000 rupees and he wants to know whether his investment will multiply to 80,000 in the next 1 year. Prableen, well, I mean, he wants to, 4x his money. So I'm sure there are calculators to, see how much you can really make. But this has been one of those steady funds, right, in the market?
Absolutely. So it's hard to say because he's just mentioned 2016 and I don't know the current value of his investment. But Pavitra, yeah, there is a rule which is called the Rule 144. If we divide it by the number of years that you have, let's say if you have 10 years with you, then you know that this is the return I need, to make my money 4 times. Or you can just divide it by the returns and know in how many years your money will become 4 times. So if we are looking at Canara Robeco, in the past, since 2016 January, it has actually delivered annualized returns of about 14.5%, I think, which is very impressive. But still, and if we believe that the performance will continue and markets would be positive, even then, I think 4x by next year would be slightly difficult. Going by the calculations, I think 18 or 19% is what he would require. But I think even if he's getting 14, 15, it's a very, very healthy number in the mutual fund space, because what he's looking at is actually absolute returns of 300%, which is very hard. And the fund till now, since January till November of 2023, has actually given absolute returns of 192%. So I think, Pavitra, that's great. But to make it 4 times, he has to, I think, generate higher returns, which may not be possible by next year. But if we add 1-2 more years to it, yes, it will be.
Okay, all right. So the last query for the day, Prableen, for you. Hitesh Joshi is writing to us from Patna. He's been investing 3,000 per month each in HDFC Mid Cap Opportunity Fund, Kotak Emerging Equity Fund, Nippon India Small Cap Fund, Pavitra Parekh Flexi Cap Fund, and DSP Tax Saver Fund. So there's a lot of investments that he's made in different schemes. He says he wants to accumulate 1 crore after 20 years. Wants to know if his investments are enough or should he invest more. What's your take?
All the 5 funds that you've mentioned, Sonal, are good. And with an investment of 3 in each, that means 15,000 per month. Hitesh can actually generate about 1.31 crores, even if you're looking at overall portfolio returns of about 12%. Having said that, 1 crore after 20 years will be equivalent to about 32 lakhs because there will be depletion in purchasing power. So if he actually wants to retain the purchasing power of that 1 crore after 20 years, what he would require, he needs to target about 3.2 crores if he is looking at 1 crore in the present date. And for that, he will require to increase his investments by about 10 to 11% on a yearly basis. So a step up. So depending on what his goal is, and if he's factored in inflation and then given us a number, then it's totally fine. He can, capture and he'll be able to meet the goals. But if we factor in inflation, that he will require additional step up of about 10 to 12% yearly.
All right, that is very important. You don't need to see, what, or just, account for inflation and see if the amount that you're making after this period is still enough for you. But Prableen, thank you very much for joining us, taking us through all of these many queries that have come in on our social media platforms. That is everything that we have for you on this edition of MF Corner today. I do hope that helps all of our viewers. We're going to wind down on that note, but stay tuned because closing bell comes up next, and they're going to take you through the final hour of trade today.